Hello everybody, this is AK. I'm back. So with all the recent good news about the banks, DBS, OCBC and UOB, there's a lot of euphoria, there's a lot of celebration, a lot of jubilation, and share prices have been going higher, and there are more expectations placed on the banks, right, that they would continue to do better and better, and the earnings will continue to increase, and dividends will continue to increase, and there'll be share buyback programs which would of course increase the value of each remaining share that is in the market, right? So there's all these positive vibes, and I sense that there's also a lot of FOMO, fear of missing out, from people who have yet to invest in the banks and have been waiting. And some people actually tell people don't invest in the banks. They have been telling people for almost 2 years don't invest in the banks because banks, Singapore banks are overvalued, etc., etc. And now there's bit of, well, I wouldn't say a bit, there's a lot of FOMO, right? And I know that because people start asking me, can I buy into the banks now? Can I invest in DBS, OCBC now at the current price? I haven't gotten my foot in the door yet. I've been waiting, that kind of stuff, right? And I always say, don't FOMO, right? Don't FOMO, because usually when fear and greed, right, they come into the picture, that's when we make irrational and bad decisions, right? Take a deep breath, calm down, okay, and ask yourself if it makes sense to get in at this price. Right, so for example, for DBS, it pays quarterly dividends, and some people say, well, if you keep waiting, then you're going to miss out on the quarterly dividends, and that drives FOMO to a frenzy. All right, so I mean, it's a valid line of thinking, but if you buy at a very high price just to get the quarterly dividends and the price plunges by 10-20%, it wipes out those quarterly dividends if it should happen, like say in the next 1 or 2 years, right? And of course, it's in the news recently that Mr. Piyush Gupta, the CEO of DBS, sold millions of dollars worth of DBS shares. I think it's $12 million worth of DBS shares just recently, right, as the share price hit all-time high, right? And then people will worry, does he know something that we don't? Well, if you ask me, I'll say your guess is as good as mine, because there are many reasons why people sell shares, right? Maybe wants to buy a bigger mansion, he's retiring soon, he wants to have more cash. There could be another reason. I think he deserves to be rewarded, right? But like I say, I don't know why he's selling. It could be that he thinks that the bank is overvalued as well at the current price. It could be, right? Who knows, right? The thing is, every one of us have our own beliefs, and we have our own circumstances to consider, right? So whether we buy or we sell, how much we sell, how much we buy, depends on our own beliefs and our own circumstances. So for example, I came across a blog article which suggests that DBS shares have a target price of $54, right? And I'm going to read you bits of that article, and I'll leave a link in the description box below as well, and you can go and read it yourself and draw your own conclusions, right? So this blogger said that DBS Bank has a robust capital position, and that this we know, and that its CET1 ratio currently is at 17.2%, which is even higher than OCBC's CET1 ratio, because its earnings are so powerful, right? It has been growing so much, it is able to replenish its CET1 ratio very rapidly, which is why Mr. Piyush Gupta says that even though we are going to do share buyback to the tune of 3 billion Singapore dollars, we are still able to increase dividend payouts in the next 1 year, right? Because our capital position is so strong, a lot of excess capital. Right, so 17.2% CET1 ratio, Common Equity Tier 1 ratio, is well above the regulatory requirements, right? And it also has very low non-performing loan ratio of only 1%. So its asset quality is actually very good, right? There's very little risk of borrowers not paying, not servicing their loans on time, right? So what happens is this blogger also look at all the target prices from different research houses, right? For example, he said Guru Focus says that DBS has an intrinsic value of $65.99. That's almost $66 per share, right? And according to another website called Value Investing .io, it says the intrinsic value is $56.50 per share. And another one called Alpha Spread, it says the intrinsic value should be about $52.58 per share. Then there's a website called Simply Wall Street that says that DBS fair value should be $80 per share. $80 per share. So you see, that's why I say when it comes to valuation, right, it can be very subjective, right? Everyone will have different target prices. Everyone will ascribe a different intrinsic value or fair value to a certain stock based on how he values a stock. You know, like I said, there's like probably 101 approaches to valuing a stock, right? And this blogger himself says that if the dividend yield of DBS compresses to 4% from here, then we see the share price of DBS should go to $54 per share. All else being equal, if the dividend yield compresses to 4%, that means the share price goes up to $54, dividend per share stays the same, the yield drops to 4%. And if you think that 4% dividend yield is where DBS isn't as attractive anymore, then $54, that's the share price you want to sell at. So that's his target price, right? So he says that even now at the current price, right, he wants to buy more DBS shares, and if he has some if he should have a war chest ready, he'll put 50% of that money into DBS now and slowly buy more, you know, dollar cost average along the way, because he thinks that DBS even currently at $43 per share is cheap. Right? So you see, that's his line of thought. For me, as I'm already significantly or substantially invested, I see no urgency in adding to my position in DBS because personally I don't think it's cheap at the current price. I don't think it's cheap, right? Like I said, I use book value, right, to value the stock. And I remember a CEO of JP Morgan said before, to pay 2 times book value for financial institution is just crazy, right? So and I also remember that when market was very euphoric in the past, a long time ago, DBS trade as high as 2 times book value, and that was the highest it ever traded at, was like 2 times book value. And then after that, something happened and the price plunged. So if it ever goes up to 2 times book value, which currently should be about $46 per share, that's when I might sell some. But according to this blogger, no, it should be, you know, his target price $54 per share, and he would probably be buying more along the way, right, until the dividend yield compresses to 4%. There is also something that I want to say with regards to that assumption, and that is he's assuming that the dividend per share is going to stay like this, and it will not go down, right? And you have to remember that dividend can reduce. Dividend can reduce. So based on his assumption, if the dividend stays the same and the yield gets compressed to 4%, the share price should be $54, and that's when he might sell. What if the dividend were to reduce by, let's say, 30-40%? Right? Then the share price doesn't have to go up. The dividend yield would fall naturally, and that can happen. That can happen in a recessionary scenario, or maybe we have another pandemic. Who knows, right? So that's his valuation technique, right? My valuation technique, I look at book value. There's no right or no wrong, right? It depends on how things unfold, how things pan out later on, right? That's why I say don't ride on other people's coattails. We must have our own due diligence done and act on what we believe, have a plan, our own plan. So this is just food for thought. This is not financial advice. It's just AK talking to himself. So if AK can talk to himself, so can you. Bye-bye.